and welcome to BloombergQuint. We're coming to the close of a year which, well, has been a train wreck of a year for most of us, certainly for the economy, less so for the markets perhaps. But what does 2021 hold as we see things right now, both for the economy and the markets? Joining us to help us with some insights is Neelkanth Mishra of Credit Suisse. Neelkanth, thanks so much for joining us here on BloombergQuint.
A pleasure being here. Thank you for having me.
Neelkanth, I'll start actually by going back to a conversation we had in March when this whole sort of crisis came ashore. At that point of time, apart from the market and the liquidity issues, you said that one needs to judge the extent of the economic sacrifice needed to curtail the health crisis, and then who bears that sacrifice. As we come to the close of this year, are the answers to those a little clearer, both in terms of the GDP sacrifice and then how it's sort of being divided across various segments?
Excellent question. So, I think that is the biggest question, and why this matters is perhaps important to understand. So, let me spend maybe half a minute, 1 minute on that. So, if you look at FY20 over FY22 over FY20, currently consensus is at, published consensus is at -1. But I think if I see the updated consensus, meaning economists have started bumping up FY21 to about, not -9.5, but say -7.5. So we're at about +1%, right? And at the beginning of the year, FY22 was supposed to be 13% ahead of FY20. So if you've gone down that low. Now, there's been 6 months of a lockdown. So if you just wipe that out, right, and assume that there was no growth in that period, and you had just stopped people from working. So 6 out of 24 gone, 25% gone. So that 12 or 13, you went down to 9. So if there is no lasting damage, no scarring because of these 6 months of intense weakness in the economy, then FY22 should be 9% ahead of FY20, right? Hypothetically, we are at +1, right? So the question to ask, and which is why it's very important to understand what is the lasting damage to the economy, what has been the scarring from the pandemic. We had done this, what I was later told was a Caldorian analysis, that is the split of incomes into government, corporates, and households. And this was when the consensus number was -10% for FY21. So we found that about 20 trillion rupees of GDP loss. What was interesting to us was that nearly 75% of that was what we called water under the bridge. Right, that people didn't earn, didn't consume, forget about it, right? So the lasting implications of that were very low. As that -20 has become -15, I think the lasting impact on the economy, in my view, is far, far lower than what we had thought even at that time, right? Because a couple of things have happened. The first is that the governments have, the companies have managed to shed costs very sharply. So generally, when this happens, you either destroy the company's balance sheet or you destroy the household balance sheet, right? So basically, they take on more debt or shed assets and all that. And what we found was that because the companies had been shedding costs so aggressively, and very interestingly, when I asked my colleagues to do a bottom-up survey and they talked to companies in the June quarter, that companies had cut fixed costs very sharply. How much of these fixed cost cuts will be retained? I was shocked. Only 7% of the fixed cost cuts were to be retained. So my question was, how are these fixed costs? These are all variable costs, right? But the heads under which these costs were classified were all fixed costs. And what that suggested to me is that the firms have, by and large, used might and scale, especially the larger ones. And they have managed to push down the pain and they have retained growth capital, right? So that's the first thing, that the risk capital loss has not been anywhere close to what I had feared at that time. Because when you stop the clock, so I had written this thought piece in one of the papers where I said, can we stop the clock? How is it different from everyone going on vacation and coming back, right? And the problem was that you could not stop the salary clock, you could not stop the interest clock, you could not stop the rent clock. And the evidence of the last 8 months suggests that to a large extent, the Indian economy has actually brought that down. So the pain has gone down to the bottom 30-40% of the enterprises and the individuals. from an economic perspective, while that is, I think, from an inequality perspective, that's a disastrous outcome. From an economic momentum perspective, that is actually the best possible outcome. Because, and I'm not recommending, I'm just commenting on what has happened, that the top 10% of the Indian economy consume more than the bottom 50%. And I'm not talking about incomes or savings, I'm talking about consumption. So the top 10, 20% have come out of the pandemic, of the lockdowns, with a better balance sheet than earlier because their consumption was more impacted than their incomes. It is the bottom 50% whose income has been more impacted than their consumption, because consumption, they do nothing discretionary, right? I mean, they almost everything is basic. So their balance sheets are much worse. But as we have come out and the savings, the incremental savings that the rich had is being sort of deployed with a vengeance. The economy, that is the economic stimulus that has come through, right? That those savings are being deployed. And therefore, the lasting damage from the economy is a lot lower. In our estimate, the about 50 to 60%, maybe 55, 60% of the losses are being borne by the government. Right? The government debt to GDP has gone up. So that is the ultimate water under the bridge, right? That you sort of socialize all the losses. I would say that about 4 to 5 trillion rupees, so out of 15 trillion, about 8 trillion is the increase in government indebtedness. About, I would say, 4.5 trillion is the loss of personal income, right? The drop in wages. But that is offset by the drop in consumption. Didn't consume, right? So water under the bridge. And it's the poor who are left with a worse balance sheet and the rich with a better balance sheet. There is about 2 trillion rupees or so, which is the loss of retained capital, retained earnings for companies. But they too have also not done investment. So basically those retained earnings generally go into capex, right? So they've not been investing, right? So GFCF has been down. So the lasting damage from this pandemic is actually a lot lower than I had feared in March. And it is partly because it has been so short-lived. And also because the big animals in the jungle have managed to muscle their way to the water bodies, and the smaller animals have been left aside. But now they are, I think, likely to drive growth. So, from economic growth perspective, I'm not that worried.
So, correct me if I'm wrong. So, we are essentially saying that the economic expense has been borne by the small enterprise rather than the large enterprise, the informal sector more than the formal sector, and wages more than profits. But because it is the second category which tends to drive spending, either on consumption or on investment, that then lifts the economy in the next year and the year after.
Yes.
Okay. As things stand right now, where are we at in this cycle? So we did not see a huge amount of government spending. We are seeing that starting to pick up perhaps. We are seeing easier financial conditions. And we are starting to see some of that consumption come back. Is that where we are at right now in the economy?
Yeah, so again, very important to think about where we are. So I think the recovery from the pandemic is mostly done, meaning a very small part of the economy. Mostly, unfortunately, schools are shut, right? Otherwise, I think most of the rest of the economy is back. But I think there are several elements that still need to be, where the momentum is still upward. The first is that FY20 also, if you remember, was not a normal year, right? So towards the end, of course, there was a big problem. But even during the year, there was a lot of destocking. So our thesis has been that there was a divergence between services GDP growth and industrial GDP growth, and that, in our view, was evidence that the industrial output was being hurt. So now, if the end demand is growing at 3%, but everyone in the supply chain is destocking, the perceived demand for manufacturers is down 3% or 4%. And that is what was showing up in GDP. The very fact that the destocking is over means that this +3, even if it's a +2, this -3, -4 has to go to +2. And that cycle is still on, right? And I don't think this gets over in 2-3 months. So that's the second thing. The element of the fiscal impact, India's fiscal policy, I think by accident, has been actually quite pro-cyclical. So in the September quarter, government spending, GFC, was actually down nearly 20%. And it actually took off 3.1% from GDP growth. If government spending had been flat, GFC had been flat year on year, we would have seen second quarter at minus 4.4%. And now, and part of this was because government taxes were weak. Part of it was the government also couldn't execute because there's a lot of government functions which you can't do from work from home, right? So as both have normalized or starting to normalize, I think, and then government tax revenues are actually going up very nicely. So I think that in the second half, the numbers are going to improve. If you see the evidence of that, like, the part of the fourth package, that Atmanirbhar, that fiscal package that came out, the largest component was the fertilizer subsidies, right? 65,000 crores, out of which 48 to 50,000 crores was just clearance of subsidy arrears, right? The government just, something that had been pending for 6 years was cleaned up. Now, why would a government do that? The government would do that because they found that, my God, more money is coming in and we don't know how to spend it. Because it's not clear that, it is going to result in some great transfer to a transition to DBT or something. I mean, not with this kind of a farmer protest, etc., going on. So I think that the fiscal situation of the government, normalization of that itself is a sign that there could be a further boost to growth, at least in the near term. And thirdly, you must have seen that export numbers have gone down, right? The growth of non-oil, non-gold exports has actually had gone to plus 5%. It's gone to 0 in November. And as with the IP and end demand, etc., and the US, Europe, lockdowns, etc. So I think by Feb, March, I think those will also start to recover. So I think the near-term momentum is actually much better than, or it can last longer than what currently markets are anchored to.
You also in your report talk about the easier financial conditions which have helped, and you see that continuing to help. You want to talk about that a little bit?
Yeah, sure. So that is on the medium-term outlook as well. So one of the things that has happened in the last 10 years is that the medium-term outlook for India, that classic 8+6 formula. So if you talk to some of the policymakers of the previous decade, they will tell you that 8+6 is much better. That 8 real, 6 inflation, and 14 nominal, right? But all of those assumptions have been thrown asunder. So basically, 8 became 7, then became 6. And one of the reasons was that the monetary conditions were excessively tight. Now, some of the tightness was required because we were fighting inflation, a very high and entrenched inflation. But I think with money supply growth being well below nominal GDP growth for like 3-4 years, I think we're kind of overdoing it. Now the M3 growth, despite the drop in the money multiplier, is now at 12.5%, 13%. And a large part of that is involuntary. That is the balance of payment surplus is driving that. Now the BOP surplus, I don't think is going away. Now, even with a $9.9 billion trade deficit, we are still a current account surplus economy, right? And this is when your non-oil, non-gold imports and exports both are at 0. So they were actually normalized. And therefore, I think that the monetary conditions are likely to stay easy. But there are several other factors which encourage me about the medium-term outlook. The first is that I think the real estate market is no longer a drag, right? The last 4-5 years, that has been a big problem, right? The formal real estate market, it's slowing down, has been a drag on the economy, and it's no longer a drag on the economy. I'm not sure if we can say that real estate construction activity can now start picking up because there's just too much inventory, but I think it's no longer a drag. I mean, that's a good thing. But the most exciting thing that has happened for me is the production-linked incentive schemes, right? Because it signals a turn in India's industrial policy, which I have not seen for, well, I would say ever, right? Maybe I'm not old enough. The thing is, the government is paying companies to grow, right? So if you cross a certain growth threshold, I will give you an incentive. The second is the government is choosing champions, right? So the government is saying that if I have 100 rupees, if earlier the government would decide I'm not going to choose between companies. If there are 100 companies, I have 100 rupees, everyone gets 1 rupee each. Who am I to select? But now the government has realized that if you give 1 rupee incentive to everyone, no one is going to move anything, right? They will just pocket it. So that classic theory of activation energy in a chemical reaction, what they're starting to do is I will give 10 rupees each to 10 companies. And only if you jump above this level, right? And so the companies are trying to jump. And more interestingly, if there are 20 companies who apply, I will select the 10 biggest companies. These are changes in India's industrial policy, which are, I think the excitement I see in the industry is absolutely transformative. I mean, I'm seeing people excited about investing, and this, in our calculation, and as you know, we've written about this in our reports, that FY27 impact of this would be 1.7% of GDP, which is a 0.3 to 0.5% addition to annual growth. It's a very substantial number. And I think the momentum can start coming in FY22 itself. Right? Because while the rest of the schemes, so out of 13 schemes, only mobile phones runs in FY22, but the investment, so what something very interesting happened in the last 2 months, that a lot of the equipment shifting from China to India for mobile handsets was happening by air. Right? And I was shocked that how can you be shifting equipment by air? But then I thought about it. I asked my colleagues in Taiwan as well. They were also surprised. But when I thought about it, if your revenue clock is starting 1st of April and you're getting 6% of incremental revenues, even if it costs $1 million, $2 million extra to shift by air, you might as well save those days and do it. And I think the same is going to happen, because if the revenue clock for the other 12 sectors starts FY23, the companies that are shortlisted for those schemes are going to be in a hurry to do capex in FY22, because they will want to meet their revenue target. And so I think the prospects for growth are actually quite bright, medium term.
Since you've detailed PLI, let me ask you a counter question there, although I don't want to go back to the financial conditions part as well. So you're convinced that the sectors that have been picked are the right sectors, and you think that there would be sort of uptake across these sectors on the PLI schemes that have been announced, or do you think that there are 3 or 4 sectors which are the right ones to target and will lead sort of the success of this scheme?
Yeah, no, I think that's, see, the people who have generally argued against an interventionist industrial policy. So it has been mostly in the last 30 years a laissez-faire one, right? I mean, the government will just retreat and will not intervene. Is that, of course, there will be errors of commission also, right? That you would choose sectors which don't have much of an option. So, for example, and now it could be our ignorance, we are not able to understand, see, on the API side of the pharmaceuticals, for which the last deadline was 30th November, we can understand self-sufficiency is a driver. But on the formulation side, where again 150 billion rupees has been allocated over 5 years, we're not able to understand what will it catalyze, because Indian firms are already pretty large. They have research budgets of $200-300 million a year. They're already pretty big in slow release, extended release drugs, biosimilars. Similarly in telecom equipment, right? So telecom hardware equipment is itself, the industry itself, going through churn. A larger and larger part of telecom investment, wireless telecom investment, is happening in software now. So we are not able to understand, maybe it's our ignorance, that how, because if the hardware industry itself is not clear how large it will be in 5 years, why will anyone put new capex to target growth and production increase? But at the same time, so there are sectors where we are not able to see the upside. But there are sectors like autos, textiles, food processing, and of course mobiles, or even medical equipment, where we think that the opportunity, and if the schemes are designed well, in mobiles, I think the momentum is clearly visible because it's in implementation. In others, we are still awaiting details. So in these, the opportunity size is significant. And I think the choice of sectors is also quite meaningful.
Neelkanth, just to go back to the financial conditions part and then a couple of questions on the markets. So is it fair? So I read your report and I was wondering whether it's whether we should expect those easy financial conditions to last into next year and then the year after. I asked because one, the M3 growth has been driven by M0 growth, right? I mean, and some of that precautionary savings may not last. Second, at some point, the RBI may want to pull back on the kind of liquidity that it's holding in the market right now. So those easy financial conditions, do you think they last? Can they last?
So the first thing is that M0 growth is being driven by the BOP surplus. See, it is the impossible trinity. It is less in RBI's control. I don't think the 10% has gone to 13% because the M0 growth, because the RBI has suddenly started to think that let's increase money supply. I think it is because they are forced to increase money supply, because they do not want the rupee to strengthen against the dollar, and dollars keeps plunging, right? Now the point is that if the BOP surplus sustains, so suppose that India next year gets included and are successful in including India in the global bond indices, say significant amount of funds come in, that will just add to the BOP surplus. As the PLI schemes start getting implemented, we think that there can be 50-55 billion dollars of extra net exports that they can generate, because the sectors have been chosen such that India is already net surplus in them. So because these are production linked incentives, right? You can't give export linked incentives because that not be WTO compliant. So the government is targeting to increase production in sectors where automatically the increased production will go into exports. So the structural move in the trade balance and in the external account balances is towards a bigger and bigger surplus. So I think that the RBI will, at least on the money printing side, unless they let the rupee appreciate, right? And you tweeted today about the question arising on warnings to India and how Switzerland has been put in the category mein khada kiya. So I think so. But I think the one way to look at it is that it's a potential growth positive, right? So the best way to deal with a BOP surplus is to boost domestic demand, right? So because your current account is in balance. I mean, you put a very high aggressive number, right? Seasonally adjusted trade deficit even in November was 102 billion. You add a $50 oil price, you add normalization, you still get to 125, 130. There is $140 billion of services exports. So you're still a current account surplus economy. On top of that, you get $80-85 billion of capital flows. What will you do with that? So this I think monetary policy, the BOP surplus gives a lot of macroeconomics policy space. The best solution for this is that the government, I think, uses it, say, for building infrastructure and boosts domestic demand meaningfully, so that import demand gets catalyzed. But till then, it will keep showing up as monetary policy space. I mean, I don't think the bigger question is what happens when economic growth has already gone to fairly high levels. When we've already seen GDP growth printed, suppose in the March quarter we see 3-4% growth. Suppose, right? I mean, I'm not saying it will happen. Suppose we say that. So in the April meeting, EC will be asked, I mean, why are you continuing with your accommodative stance, right? Because the economy seems to have revived now. The one thing is, of course, by then I think inflation would have fallen meaningfully. You must have seen China has gone into deflation now, right? Because pork prices are adjusting. And the way vegetable prices are moving, I think by March, April, I think food definitely will be in deflation by then, right? And I think that at least on the inflation side, there will be less pressures. So what happens when they shift away from that accommodative stance? I mean, will bond yields flare up? Or, and this is where I have a very large difference from consensus, will the market start to worry about the fiscal deficit being a lot lower than they had anticipated? Because currently people are doing basic math. This year at say 6.5, 7, let's assume 1% of expenditure doesn't happen, but fiscal, the revenue will pick up. So let's assume 5 to 5.5% next year. Well, if you put those numbers, and if the FY22 GDP growth is really as high as it can be, I think the next year the government won't be able to spend the money it is getting. So what will happen to bond yield? So I'm not too worried about a change in the RBI's accommodative stance.
Okay. Neelkanth, onto the markets now. I think you said that markets are on the verge of becoming as expensive as they have been in the past. So it has to be earnings growth that has to then lead from there. And you picked a couple of sectors where you think that earnings upside could come from. Financials, some parts of industrial. So I think energy, you said, correct me if I'm wrong, and you said consumer discretionary. Is that where you think that there is upside for the markets from here on?
So consumer discretionary, we are very clearly focused on, because that's the categorization in the market. So, but we are focused on four-wheeler autos basically, and of course financials and industrials. So I think these are three sectors where we think that earnings estimates can go up. But more importantly, I think the market will do well if the earnings estimates don't go down, right? Because what we found, and it's not a Nobel Prize winning finding. It is a normal thing that index EPS from the time that it is introduced, like FY23 is at plus 21. From the time it is introduced, it generally tends to fall 10 to 35% from there, right? Now, the thing is, in such an environment, which sectors drive that decline? And we found that 30 to 40% of index EPS integer decline is driven by private banks and consumer discretionary each, right? So the declines are very heavily skewed towards them. So if you are reasonably comfortable about those numbers, then the risk of a downgrade to 22 and 21 is lower. 20 or 23 is lower. And particularly, as I said early on, if 22 numbers, the GDP numbers themselves have to be bumped up, then I think in parallel, the 23 EPS also goes up, even if the year-on-year growth is not higher. So I think that is what the market will be geared to. And I think that will be driven by industrials, banks, and autos, four-wheeler autos.
Banks on the premise that asset quality strain has been less than feared. What about industrials and on autos?
So in industrials, I think that first, the fiscal math is going to be very supportive. We haven't done the numbers, but I was sitting through a presentation by the Delhi research houses, and they've done this aggregation of state budgets, and they found that state capex is down 41% so far, right? So clearly, as the fiscal normalization happens, which I expect it to, and I think it's already happening, I think the outlook for government capex improves significantly. The second part to that is, as I said earlier, if the government is able to finalize these companies, the winners of these incentive schemes by March, they are going to be stampeding to do capex in FY22. And even for the handset scheme, you must have seen, one of the largest industrial houses or largest business groups in India has launched a new electronics company, which was formed in April 2020 with $1.5 billion of new capex. Now, when was the last time you heard of greenfield investments of that magnitude? Now, I don't know over what period it will happen, or it will be successful or not, but they got 500 acres of land, right? The last I heard of this was like 2010, right? So I think as the investment, and there will also be competitive stresses in the sense that there are companies which are waiting for the PLI schemes to get launched, the details to come out, because they think that if we are not able to compete, because if my competitor wins this, in 5 years' time, I will be 1/3 his size, right? And there are upstream investments. So if all of this cell phone assembly starts to happen in India, a lot of the upstream capex will start moving to India as well. So I think the industrials are likely to see, I think, significant move. Autos is more of a bet on the fact that a large part of the PLI budget has been allocated to autos, and we think that if it is, say, in car exports or even electric vehicles, I think the prospects and sentiments around that will improve.
On the fund flow side, Neelkanth, as things stand right now, no reason to anticipate any major change in global monetary policy that would, lead to an outflow. Domestically, there's more than enough money coming in whether it's via mutual funds or direct retail equity investments. So fund flows is probably not an issue into next year.
So not domestic flows, I don't see as an issue, but I think the global flows. See, it's actually not going to be a very short answer, but to summarize it, so basically our finding is that despite this anchoring people have, that 0% interest rate in the developed world means a flood of flows to emerging markets and to India, is something that should be questioned, right? Because if you actually go out and see how those savings come about, what is remarkable is that in the last decade, most of the last decade, Europe was at 0 or negative, and US was close to 0. In the last 2-3 years, they've been bumping up rates a bit. But the outflows from US and EU, portfolio outflows, as a percentage of GDP have been declining, right? And flows to Asia also have been declining. And the reasons for these, if you investigate, so despite negative deposit rates, in Europe, if you look at incremental household savings, 60% plus of incremental household savings have gone into deposits, despite negative rates. If you see and so I have to first understand where the money is coming from, right? So there's a saver who's putting into a vehicle, who's then deploying it in Asia or emerging markets. That vehicle is pension funds, right? In the US, insurance funds in Europe, and maybe mutual funds in the US as well. Now, both mutual funds and pension funds are not getting a very large share of incremental household savings in the US. And then the allocation. So suppose we say, okay, fine, pension funds are not getting money, or not in as much as they were getting 15 years back, but can they increase allocation to equities, right? Because bond yields are zero. That has gone from 27% in 2008 to 34% in 2017 and back to 33% in 2019. Right? So the assumption that at 27 become 50 or something because they're desperate. In Europe, the money has gone from money market funds and bond funds into alternative assets, which is why private equity, venture capital, all are booming. So why is this current inflow happening? Partly because India's rates have gone up, because the what they call the tyranny of the benchmarks, right? It's not just the passive money, but in fact the benchmark money. If the weight of India and the benchmark goes up, which is what the game that China has played so nicely, that and so people pull out money from other markets and have to sort of benchmark to India. And when a big uncertainty goes away, which is like the vaccine or the US presidential elections, all the money on the sidelines then gets deployed. But beyond a few more weeks, I don't expect these flows to be of this magnitude. Right? I mean, it'll be a more steady Eddie kind of environment, because the initial savings deployment that we are seeing is not changing yet. But that doesn't mean that we should be negative to the market. I don't think even if the flows didn't happen, so long as the expectations of India are changing. That's the question I ask, right? Are markets going up because of flows, or are flows happening because India's economic outlook is improving? And this theory, because the way I look at it, the basic principle of stock prices is that a stock price means there was a buyer and a seller. If there was only buyer, then there's no change in the stock price, right? So there is someone selling as well, right? This flows-based argument is something that I struggle to explain. But anyway, I think that the prospects are improving and the market should be fine.
Okay. Absolute final word. We haven't dwelled on it because I'm not sure what there is to say, but the risk or the sort of cloud of how the pandemic progresses, how quickly the vaccine gets distributed, particularly India, etc. Those remain, sort of material risk factors, at least in the first half of the year in 2021.
For the world, yes. In India, I don't think anyone is waiting for the vaccine. So I mean, there are nightclubs running full, as they had that joke during Bihar elections, right? I mean, it's a sad thing. I think people are still getting infected and they're serious. But in Bihar, that joke was going around, right? That coronavirus, Bihar mein bheed mein dam ghutne se mar gaya, right? So people are crowding. I don't think India is getting badly affected, but yes, I think in the rest of the world there is a problem. And there could be volatility around that.
Neelkanth, thank you so much. Really appreciate you taking the time to speak to us in such detail. Thanks so much.
Pleasure being here. Thank you.